to create a system to be able to do that. So I'm going to go ahead and turn the presentation over to my partner, Kyle Fuller.
Hey, everybody. I am going to mute everyone really quick, and we're picking up some background. Give me a thumbs up if you can still hear me. Perfect. All right, I'm going to try to cruise through this as fast as I can, just to be conservative of everyone's time. And what I want you to do is just sit back and relax and just try to absorb the concept, okay? Don't try to understand everything fully, because there's a lot going on with this concept. And so just try to absorb the initial mindset, because infinite banking, first and foremost, is a mindset. And if you can understand the mindset, it is then a process that has certain rules you'll want to follow. And from there, it's a product. And so if you understand the bigger picture, that's going to help you really grasp the concept better. And so right now we have a serious problem within our families. And that problem is, no matter how hard you work or how successful your business becomes or how much money you amass in your life, your legacy is not going to last more than 3 generations. Now, every single culture, the American, the Chinese, the Japanese, the Europeans, all of them have this same issue. And they call it, in America, we call it shirt sleeve to shirt sleeves in 3 generations. And what that means is your family's wealth isn't going to last more than 3 generations. And actually, the Japanese version is the one that I resonated with the most. And their example of it is called, it's rice paddies to rice paddies in 3 generations. And what that means is you have the first generation who works really hard and develops good, sound money principles. And they're in the fields working their butts off, and they store up some money, and they have this capital that the second generation inherits. And the second generation goes to the big city and they live a more lavish lifestyle. They end up spending most of that money, and they don't develop the same money habits that was used to create that wealth. And by the 3rd generation, their kids are now returning to the rice fields to start all over again. And we see the same thing in the Hispanic culture, the American culture, Canadian, it doesn't matter. It's all the same. Okay. And the reason that's happening is it comes down to one word, and that is stewardship. We have to be good stewards of our money. And if we're not, I'm sorry, there's just no other way to say it. Our wealth is not going to transfer more than 3 generations. Now, in the late 1800s, there was a gentleman by the name of Cornelius Vanderbilt. And at the time, he had a net worth of $100 million. Now, that in today's dollars would be the equivalent of about $200 billion. He was enormously wealthy. In fact, he had more money than the US Treasury at that time. And he left 95% of that wealth to his heir, which was his son. And his son doubled that fortune in 9 years. And after that, their family wealth never grew again. And 48 years later, the first Vanderbilt died broke. How on earth is that possible, to go from a net worth of that amount of money to 3rd generation, you have a family member that died with nothing? Now, at the exact same time, there was another gentleman by the name of John D. Rockefeller. He also amassed a serious fortune. He left the majority of it to his heirs. And today there are almost 200 Rockefeller family members still living very well off the trusts and foundations that he started. Now, the difference is, and by the way, their family is about 6 generations deep into that wealth. And the reason they were able to do that is because they taught proper money principles in each generation. They made it a very serious priority for their family. Now, I've seen the same exact thing in my family. My great-grandfather was Monroe Blakely, and he owned Blakely Oil, which, and about 50 to 100 gas stations between Arizona and California. And he was incredibly wealthy. And in fact, I've seen this home video of him flying in his private helicopter. And now this is my great-grandfather. And yet my father grew up extremely poor. Okay, he's third generation. There was nothing left. So I've seen this in my own life as well. And so why are Monty and I here? And the reason we're here is to help you and your families understand that it is possible to have your wealth last longer than 3 generations. Now, what I'm about to show you, this is not a career for Monty and I. It's not a job. Now, we own our business, but it's not even a business for us. What Monty and I teach people, we consider this our calling in life. I will literally teach this concept that I'm about to show you until the day I die. Now, we have a unique advantage in our business because I myself, I'm 31 years old. I'm about 30 years younger than the average agent in my industry. Now, the reason that's significant is because I will help you implement this. And most of my clients I will outlive because they're quite a bit older than me. But I'm going to be here to help them start this process. I will be here to help educate their kids. And from age 70 or 80 till 100, which is my expected lifespan, I'm going to be here to help educate the grandkids. That's how important this is for us. Retirement is not a word in my vocabulary. I've deleted it. That word means nothing to me. And so we're here to help set families free. And if there's one thing I know about the Hispanic culture and family unit is that the friends that I have that are Hispanic, I feel like their families are fiercely loyal. They keep very close ties. They stay together. They work as a family group. And if you have that on your side, the rest is pretty easy as long as everyone understands proper money principles. Now, something you'll learn about Monty and I is we are all about family. Everything we do is for the family unit. Now, this is my little family. That's my wife, Diana, and my little boy, Riker, who's turning 2 in July. And when you see how powerful this is, not just for your family, but when you can connect the big Fuller family, which I'm going to show you at the end, you're going to see how significant this can be for you personally and also on a business level. Now, right now in America, there are 2 movies being played. The first movie is titled A Reassuring Lie. Now, this movie is vastly popular. It is the most popular movie you've ever heard of. The tickets are sold out. There is a line out the door and around the corner for miles. You've never seen people line up to attend a movie like this. And the plot of this movie is that creating wealth is complicated and you need to give up control to other people and just invest your money automatically without thinking about it and without keeping any of the control for yourself. This is what Wall Street has programmed us to think. Take your hard-earned dollars, put it in the stock market so you can get a higher rate of return, and when you need to retire in 30 years, there's going to be enough money. Now, that is the reassuring lie because that plan does not work. And even if you are one of the few that it might work for, that is not a strategy for building and keeping wealth long-term. Now, the other movie that is being played right now is titled An Inconvenient Truth. There is no line for this movie. There's very few of us in the theater. And the plot for this movie is unless you take ownership and control of your money and develop sound money habits that'll pass on to the next generation, and you learn to start saving your money automatically and then invest it very intentionally. If you will do that, now that takes hard work and discipline, but if you will do that, your wealth, not only you'll keep more money for yourself, but your kids and grandkids are more likely to develop those same habits and that'll carry your wealth past a 3rd generation. Now, Monty and I give most people a 10 to 15 year plan to get free. Most families, most business owners, most individuals. Now, what do I mean by get free? I mean, get your passive income higher than your monthly expenses. That is true freedom when you don't have to work anymore. Now, we can give most people a 10 to 15 year plan to do that with something that Wall Street can never, ever give you, and that is certainty. We can show you how to do that with 100% certainty, which is what I'm going to be going over right now. So we are going to be talking about this book. Now, I noticed there was a gentleman that logged on that said that he works for a bank, which is wonderful, because we are going to be talking about how to become your own banker. Now, this book was written by Nelson Nash, and this book changed my life. It changed my family's financial legacy forever 6 years ago when I first read it. And I learned this from an orthodontist here in Chandler, okay? And in this book, the very first page of the book, and I'm going to share with you in a little bit why it's significant and why you will want to become your own banker. The very first page in the book, Nelson says that becoming your own banker, the infinite banking concept, is a text for a 10-hour course of instruction about the power of dividend-paying whole life insurance. Now, two significant things here. This is a process that takes most people about 10 hours of exposure before all the light bulbs start turning on. Okay, this is very backwards to the way we've been taught to think about our money. And so I'm going to try to cram that 10 hours into about 40 minutes right now, which is why we're going to be moving quick. But don't worry, I'm going to answer every single one of your questions at the end, because I'm going to give you some materials and some homework to go do after this. Now, the second part is we are talking about the power of dividend-paying whole life insurance. Now, several of you that have logged on that have heard about whole life, I could just picture you right now. Your eyes probably rolled back into the, as far into your skull as they could go, and you probably thought about logging off right now, because what we hear about whole life at the middle class level is that it is a terrible investment. It's got a low rate of return, and those things are absolutely false. It is not true. Now, on the second part of this page, Nelson says this book is not about investments of any kind. It is about how one finances the things of life, which can certainly include investments. It is not about rates of return. So you just learned something very significant about whole life insurance. It is not an investment. I'm going to say it again. Whole life is not an investment. You've heard it's an investment. You've been led to believe it's an investment, but you have been duped. You've been lied to. When you talk to someone after you log off today, you might talk to your neighbor, your business partner, the matriarch or patriarch of your family, and you're going to say, what do you know about whole life? They're going to say, oh, Frankie, Joe, don't ever do whole life. That's a terrible investment. As soon as you hear that word, red flags should be going up in your head, because now you know they don't have a clue of what it is, because they can't even classify it right. Whole life insurance is a savings vehicle. It has nothing to do with investments. This whole life policy I'm about to show you has more in common with your everyday checking account than it does some investment grade vehicle. Now, let's just imagine for a second that all of us are going to go attend a financial seminar. So we show up and there's 3 keynote speakers, and they're all speaking at the same time. And there's 3 different rooms that we can choose from. Now, the first room, we go and look who's going to be speaking in there. It doesn't tell us who they are. We don't know if they're male or female. We don't know what kind of business they're in. We don't even know what they're going to be talking about. The only thing we know about the individual is that they have a net worth of $100,000. In room 2, the exact same situation. We don't know anything about the individual speaking. We only know they have a net worth of $1 million. And in room 3, same scenario, except the individual has a net worth of $1 billion. Now, how many of you are coming into room 3 with me? I would assume all of you. It's an easy question to answer because there's something about a billionaire that intrigues us. They have something we don't have, which is an exorbitant amount of money. So we want to know, 1, how did they get that much money? And 2, we're probably very interested in learning because they probably know something we don't know about money. And so Will Rogers said the problem in America isn't so much what people don't know. The problem is what people think they know that just ain't so. Now, when it comes to whole life insurance, the middle class has been duped. At the middle class level, we believe that it is an investment product. It's got a low rate of return, and it's a terrible place to put money. But if you take a step back and look at who's actually buying it, your curiosity should be piqued, because here's a few individuals that own whole life insurance, and they not only own it, but they love it. plus about 54 current other elected officials that we know of. Here's a few companies that own this type of asset. In fact, Walmart owns over 1 million life insurance policies. And they were buying them so fast about 5 or 6 years ago that the IRS had to step in and slap their hands because they were purchasing insurance policies on employees without them even knowing. So what would cause Walmart to try to get their hands on these policies so rapidly, right? They wanted them for a specific reason, but none of this even matters, okay? Because here's what really did it for me. When you understand that banks are the wealthiest companies in the world, no one even comes close to the amount of money they generate and have. And they also happen to be the largest purchasers of whole life insurance in the world. No one even comes close to the amount of insurance that these banks own. And so you have to ask yourself this question. At the middle class level, we have been told that whole life is a terrible place to put money, and you'd have to be a complete idiot to buy it. But the wealthiest companies in the world buy it in larger quantities than anyone else. So either banks are extremely stupid or they know something that we don't know. And I can tell you it is absolutely the latter. These banks understand something about whole life that we are not taught at the middle class level. Now, here is exactly why banks buy whole life. This comes from a gentleman by the name of Barry Dyke. He wrote the book, The Pirates of Manhattan. I would highly recommend you read that book. It is very eye-opening. And as far as I'm concerned, he has done more investigation and research into where giant big banks, corporations like Walmart, these giant billion-dollar hedge fund managers, CEOs, executives, where are these guys putting their money and why? And so he says, attached is irrefutable evidence that high cash value life insurance for banks known as BOLI or bank-owned life insurance is still a major and vital asset on the bank's balance sheets. So right there highlighted in green, during the financial crisis and even today, the life insurance accounts were perhaps the only place the banks did not lose money. In addition, all of these banks, this is very interesting, have more invested in high cash value life insurance than they do their defined benefit pensions. These banks have more in insurance than they do in their own retirement accounts. That should stop and make you think. He goes on to say, as you know, high cash value life insurance has proven to be an exemplary financial instrument for banks, even though the media fails to acknowledge these facts. That part I don't agree with because we know the media never misleads us and they never lie. And so we can take that one for a truth. No, I'm just kidding. Now, he says, I could go into more detail. This is the end of the letter that we have from him. But the gist is that banks are still the biggest buyers of high cash value life insurance because they completely understand the economic benefits they receive from life insurance companies. Number one, professional money management, tax deferral, unmatched stability, high non-correlated returns, that means not attached to the stock market, improvements to their income statement, and unsurpassed liquidity in the event of a financial crisis. This is how they define whole life insurance. It is very different than the way you'll hear it being described at the middle class level. So think back to what Will Rogers said. The problem in America isn't so much what people don't know. The problem is what we think we know that just ain't so. Now, at the middle class level, we hear whole life is a terrible investment. It's got a low rate of return. It's expensive. But that sounds nothing like how the banks look at it. Now, I'm willing to bet if we all put our heads together for 5 minutes and we said, let's describe and build the perfect asset. What are some of the characteristics that it would possess? It would probably have, it'd be tax-free. It would have an amazing track record. It would have high returns, and it would be extremely liquid. Those are probably some things we'd come up with. And if we spent a few minutes building that list, it would probably sound very, very similar to what I just read off. Okay, banks fully understand how powerful whole life insurance is. And remember, who's got all the money? They do. Our thinking has to change. We have been lied to. We have been duped. It is not what it's not what it has meant to look like at the middle class level. Now, Imagine playing a game. All right, we're going to go play a board game, and you sit down to play, and the game has been playing for many, many hours. And so you're just kind of hopping in full-fledged. There's no one there that's teaching you the rules. You just have to start playing and figure it out as you go. Now, it's going to be a little bit difficult to play that game well if you don't understand the rules. And so you're playing for a few hours, you're extremely frustrated, and then you have this wonderful stroke of luck. You find the instruction manuals sitting, next to you for the board game. And you pick them up to start reading them, and then you realize you never even learned how to read. And so even though you found the instruction manual, it doesn't do you any good because you never developed that the ability to read, so you can't comprehend how to even play the game, even if you found the manual. And so the reason I share that with you is think about money, the money game. We are thrown into the money game, which is life. We try to figure it out. No one ever taught us how to play it or play it well. We just kind of learned as we go. Most of our money habits we get from our parents who didn't know how to play the game either. And so here's the inconvenient truth that I shared earlier. We have to, as individuals, as families, as businesses, grow and develop ourselves. We've got to understand life insurance lingo, real estate lingo, tax lingo. You've got to understand the words that are associated with the game. And if you'll grow and develop yourself, you're going to be at a much higher advantage in the money game. All right? And if you don't know the rules, you will continue to play at a serious disadvantage. Now, in Nelson's book, he goes over this problem. And I am convinced that this is the issue why I know so many individuals who work so hard and they just will never get ahead. They will not win the money game because they're not playing it right. They're not playing it the most efficient way they could be. And so Nelson said are financed either by credit cards or bank loans. The balance is financed by paying cash, thus giving up interest that could be earned otherwise. And the problem is that all of these items are financed by other banking organizations. Okay, so here is a rule of money that we are never taught. He says, when you pay cash, you are giving up interest that could be earned otherwise. Now, this was a hard one for me to initially wrap my head around because I was taught from my father, who was taught from his father, do not borrow money from a bank or a financial institution because why? You have to pay them with interest. See, as a culture, we hate interest payments. We don't want to pay anyone interest. So what do? We save up and we use cash. But here's something that no one ever taught us. When you use cash, you are giving Now, with these whole life insurance policies, they have some very unique features that you'll never hear about at the middle class level because no one ever shares this stuff. They only share whole life insurance has a low rate of return, which is absolutely false. I'll send you a video at the end of this debunking that myth. But with these whole life insurance policies, they have something called a flexible loan provision. All right. And what this flexible loan provision allows you to do is it allows you to borrow money from the insurance company and access your cash without having to qualify, without paying penalties and taxes, without waiting until you're 59 and a half, which, by the way, I'm just going to share with you, if you're waiting 20 or 30 years to use your money inside of some type of retirement account, you are missing an enormous opportunity. Opportunities are coming every single day, and people who have access to their cash and capital are going to be the ones that can take advantage of those deals. You can get access without having someone else determine your repayment schedule. This one is very key for business owners. Imagine being able to access a loan that you control and you get to decide how it's paid back. Could that help your business in an uncertain time like we're seeing right now with the corona? You can access it without proving this loan is for an allowable reason. You can get access to it without wondering if the loan is going to be approved. And lastly, this is my favorite part, is you can get access to your money without interrupting the compounding, which means you can earn guaranteed interest, which is what I'm going to show you next, and use your cash at the exact same time. So it allows your money to do two things at once. And if you can get your money to do two things at once, you are going to start playing the money game at a serious advantage. So I'm going to pull up a couple calculators right now. Now these are some very basic calculators, and if you've seen our other videos, you'll see some of the more intricate calculators we use to show this process. But let's just assume we're going to go out and we're going to buy a new vehicle. And right now I drive a Toyota Tundra, and I love that truck. I'm going to keep buying them. And those trucks are about $45,000. Okay, so I'm going to put $45,000 into one of these whole life insurance policies. Okay, these are I use for my savings accounts. Okay, they're not an investment. So I've got $45,000 inside that policy. Now the internal rate of return for one of these insurance policies is 4%. Now you're going to hear people all the time. This is what they complain about. Oh, whole life insurance got a low rate of return and they earn like 4%. It's terrible. But what they don't understand is that 4%, one, is guaranteed, and two, that 4% is net. It's a net number. It means that is after fees, commissions, and taxes. Okay, that is a 4% net number. So what that means is if you were to factor in commissions, fees, and taxes, you'd have to get an 8% return in the market every single year without fail to match what these insurance policies will do on a guaranteed basis. And I'll send you the video with the calculations I use to do that and show that to you. Most agents do not have the ability to show you that. They have no idea that's even happening. So we have a couple of options. If we have $45,000 in my insurance policy, we can withdraw that money and go pay for the car cash. But remember, when we withdraw and use our own cash, we now have nothing to compound on. That's the opportunity cost. Okay, so what we're going to do is we're going to call up the insurance company up here in the top left, and we're going to borrow $45,000 for them. Now, when you access a loan from the insurance company, I just read you off that big list. They do not ask you what it's for. They don't ask how you're going to pay it back. All they ask you is, do you want a physical check or do you want it electronically deposited? It is that simple. You have complete control. This is your system. And it's been this way for 150 years, by the way. Now, there is going to be an interest rate attached to that money because you're borrowing against your cash from the insurance carrier. Now, we're moving a little bit quick, but don't worry, I've got a ton of videos that'll really break this down in depth for you. So let's assume, we're going to assume worst case scenario, and the insurance company charges you 6% for that loan. Now, that is much, much higher than it is currently, but I just want to show you a worst case scenario and just to get your mind thinking differently, okay? So let's assume we're going to pay that back over 60 months, 5 years. So that means the payment over here on the right now is going to be $865 for 60 months. So that means we would have paid $51,900 for that vehicle. This is why nobody wants to finance, because we hate the interest payments. Why would you pay, we'll call it $52,000 when you could just pay cash and pay $45,000? No interest payments. But see, when you leave the money in your policy and you use it as collateral, that $45,000 has been earning me that 4% interest rate every single year. And at the end of the 5 years, your account in your policy is going to read $54,900. So how is it possible to earn more money at 4% than you paid at 6%? And the reason that's happening is when you borrow money, the interest starts out higher, and as you make those loan repayments year after year, you're paying interest on a smaller amount every year. Okay? With the compounding of your money is starting at $45,000 and it's getting larger every year. Now, this happens every single time you do this, like clockwork. And so I just showed you how to play the money game at an advantage, because if you paid $51,900 for a vehicle and at the same time you earned $54,900, how much did that vehicle just cost you, your family, or your business? It didn't cost you anything. You got back all the principal, all the interest, plus you made a profit. And all you did to make that happen was make vehicle payments. If that doesn't get your wheels turning, I'm not sure what would. Because most of us that have driven 5, 6, 7, maybe some of us are at 10 vehicles at this point in our life. If you think about all the money you've spent for those vehicles, you don't have anything left. You have the current value of the most recent vehicle. That's it. Because no one ever taught you how to keep control of the money the entire time. Now that we understand a little bit about the insurance policies, enough to be dangerous. We understand kind of the economic reasons why the banks like it. So we understand what asset they're buying. Now let's try to understand how they move their money. What are they doing for their business that allows them to be so profitable? Now, this is called fractional reserve banking. And what happens is we go and deposit, let's say $10,000 into the bank. And let's assume they're going to pay us a 4% interest rate every year that it's there. Now we know it's not 4%. It is much, much lower than that. But you're probably ahead of me and you know where I'm going with this. We know now where we can get a 4% return every single year. Now, we love depositing money in the bank. Some of us get it electronically deposited. We don't want to take a physical check. We want it there instantly. Now, when the bank receives those deposits, they've got those big old vaults, right? They take that money and they stick it in the vault and they just sit on the money until we come back, right? Is that what they do with it? No way, those vaults are empty. They're there for show. As soon as that money comes into that bank, they lend it out as fast as possible. I mean, the second it comes in, they are moving it out. Let's say they're loaning it to me for a mortgage and the interest rate is 5%. We sign a contract. Who do we make payments back to? The bank. Whose money are they using to lend it to me? Frankie's money. Frankie puts the money in the bank turns around and lends it to me, and I pay the bank back with interest. What is that called? That is called cash flow, okay? Now, as soon as those payments come in, they lend it out to Monty. He's buying a new car. He signs a contract, finances it to them, makes payments back to the bank. Rebecca's doing a house remodel. She borrows money, does a home equity improvement loan, and she's paying the bank back. Debt consolidation, credit cards. See, look at how a bank uses their money. But what have they taught us to do with ours? Banks and Wall Street have traditionally taught us, take your money, park it in the bank, get a CD, put it in mutual funds, and let it sit for 20 or 30 years, and then use it when you're ready to retire. But a bank doesn't do that. See, we got to do what the banks do, not what they're telling us to do. The bank keeps money in motion as fast as possible, and so should we. Now, on that first deal, that for the home, they made a 5% interest rate there, and they paid us 4%. So they made a 1% spread on that deal. They made 2% on the vehicle, 3% on the house remodel, and 14% on the debt consolidation. That's a total of 20%. So most people would say the bank's making 20, they're paying me 4, they're making a 16% spread. That's wrong. It's 500%. 20% is 5 times greater than 4. We got to start thinking differently about our money. The reason I show you this is because the average commercial bank right now makes between 400 and some of them almost 1,900% annually on the money we just parked there. And what do they give you to keep it there? Next to nothing. You'll have nothing to show for keeping tens of thousands of dollars in the bank over a 30, 50, 60-year period. Some of us have deposited hundreds of thousands, if not millions of dollars in a bank. We have nothing to show for it. So what we're showing with this concept and why it's significant to become your own banker is if you'll replace that entity and start moving your savings into a life insurance contract that you own and control. Now for the mortgages, the vehicles, debt payoff, house remodels, vacations, college educations, all of that money can stay in the family now. Now, I'm not saying we do not use banks. Monty and I still have bank accounts. We have business loans. You know, we still utilize those functions of the bank, but we keep the majority of our savings inside an insurance contract that's going to get us a rate of return that is 80 to 400 times higher than what the bank's going to pay you. And you can use your cash and earn interest at the same time. Okay. That's all we're saying about that. So it's very important to understand how the banks work. Now, this is what I'm going to end with this. This is what an illustration looks like. This is a very common way we'll design them. And so what you'll notice is there are rules to this system, and rule number 1 is pay yourself first. It doesn't matter if you're an individual, a family, or a business owner, you will hear this rule of money from everyone. Dave Ramsey, Robert Kiyosaki, Tony Robbins, it doesn't matter who you like to read about. Rule number 1 is always pay yourself first. So in this case, this individual is paying themselves $10,000 a year. That's how much they're saving into this insurance contract, okay? And so they're going to put in $10,000 a year for 7 years to accumulate some cash inside the policy. We call this the capitalization period. It's much like starting a business. You're going to capitalize the first few years of your business until you're profitable. Rule number 2 is pay yourself interest. Okay? You are 2 players in the money game now. When you decide to commit to this process, you are still a consumer, but you're also a banker now. You're going to be at a serious advantage. So when you borrow money from your system, you need to pay it back with interest. See, when consumer Kyle borrows from banker Kyle for a vehicle, I pay it back with interest, because either way I'm getting the money. And so that is a sound money habit. If you'll develop, that is a very sure way to keep more of your wealth. And so in this case, we're going to purchase a vehicle in the 3rd year because we have enough cash to do that. We borrow out $15,000 for the car purchase, and we're going to pay back ourselves $300 a month for 5 years, which is $18,000. Okay, that's paying yourself interest. So if we look at the first 7 years of the policy, we put in $70,000 of deposits and $18,000 of loan repayment for $88,000. But we took out a $15,000 loan, so our true net injection is $73,000 out of pocket. And at the end of 7 years, there's $65,000 in our account. So if you take 65 and divide it by 73, you're going to get the number 0.9. We just showed you how to get 90% back of every vehicle you purchase on the first vehicle, all right? Now, rule number 3 is learn how to recapture money. You can keep that flow of money inside your business, within your family, year after year, for anything you decide to use this for. Now, we're going a little bit quick, and don't worry, I have this entire illustration pre-recorded on another video. I'll send it to you. You can study it in nauseating detail, but I'm trying to get through this a little bit quick just so you can get the idea. So we're going to go into year 8 now. So we're getting ready to buy our second vehicle, and notice on the left, there's no more deposits coming into our policy. I would never, ever have someone do that. But the reason we illustrate it this way is just to prove to you that you could capitalize a policy and then put nothing else into it, just use it for your vehicles, and you can make a considerable amount of money just doing that. I'll show you how efficient that is. But this is actually one of the most inefficient ways to use this policy, and it's still this good. So notice at the end of year 7, we have $65,000 in our account. We're going to go buy a $20,000 vehicle now. So we borrow $20,000 and we pay back $400 a month for that vehicle over 5 years, or a total of $24,000. So we borrowed out 20 and we replaced it with 24. So our net injection over those 5 years is only $4,000. We took out 20, we put back 24. But our account grew from 65 to 81. That is a $16,000 growth. We put in $4,000. That is a 410% return, and all we're doing is buying a vehicle and making car payments. You see, when you are the banker, you are on the receiving end of all those interest payments, and your money is compounding at the exact same time. See, it's very hard for someone to convince me now to go into the stock market and buy mutual funds, because I can get these types of returns just financing my vehicles. Now, we're going to go buy another vehicle. We got $81,000 in our account. We're going to buy a $25,000 vehicle. We're going to pay back $500 a month, $30,000 over 5 years. So we took out 25, we put back 30. The net injection is $5,000. Our account grew from 81 to 103. That's a $21,000 growth. That's a 430% return. And each year you do this, those numbers go up and up because you're never losing control of all the money that's in your policy. It is always working for you every single day. Now, this is 12 vehicles in now. So this individual is now 88 years old. So we ran out this contract. Let's assume they pass away at 88. So let's look at a snapshot of what this looked like over one lifetime. So we put in $70,000 initially to get the system started over 7 years. And we bought 12 vehicles. So in this case, we did one at 15, 20,000, 25, and then 9 more at 30,000 is what I showed on this. That's a total of $396,000. So a total of $466 total, but we took out $330,000 worth of loans to purchase those vehicles. So 466 minus 330, our true net injection is $136,000 out of pocket. We have almost $800,000 in cash at the end of this. And guess what? This is life insurance. There's been a death benefit that's increasing every single year. And the only way to make it do that is if you have someone that knows how to design these policies correctly. So not only are we more cash efficient during our lifetime, but our family is going to inherit just under $1 million, 100% tax-free, and all we did is buy vehicles. Now, I told you at the beginning, this is a very inefficient way to use this system. One, we stopped depositing premiums in, which is a terrible idea. And two, we used it to buy a depreciating asset, which is a vehicle. Vehicles do not make you money. They depreciate in value. What if you use this system to buy an asset that produces you cash flow and it appreciates at the same time? This is why we have several real estate partners, because when you use this to purchase real estate, these numbers explode. And that is how we're able to give business owners, families, individuals a 10 to 15 year plan to be completely free. And we can help you do that with certainty. Now, you don't have to buy real estate with us. We're all business owners. We have business overhead. We have business vehicles, expenses, whatever it may be, business equipment. You can use the same policy with your business and do the same thing. So think about that for a second. All the business overhead you have, that can all be recaptured. We do this with our company. One, you have access to capital at all times. So think about the coronavirus. When that hit, we saw so many businesses go under or get hurt really bad in less than a month. And the reason that happened is because they didn't have stored capital on hand for an emergency. We will help you design plans that will save you in a time of uncertainty. So the way we've structured our business, when the corona hit, even if we had no clients come in for 8 months, we could have survived. We could go the rest of this year with no more business because we have stored capital inside these policies. And so first and foremost, if your foundation's not set and you don't have protection against, an uncertain time like we're seeing right now, it doesn't matter how profitable you were the last 2 or 3 years, because one bad event like this could completely take down your business. And so there's a lot going on here, but these policies will act as an opportunity fund, your savings account, your hedge against a disaster like we're seeing right now. But when you take this system and you apply it to a family of this size. This is my family. I'm the second oldest of 11 kids, okay? So you think about what I just showed you with one person owning a policy, financing one vehicle every 5 years. Imagine if you tied in a family of this size with those vehicles. One, if mom and dad or the matriarch and patriarch of the family can understand these principles, every single vehicle in the family is potential lifestyle dollars for mom and dad. It's also legacy dollars for the kids. See, right now we all buy our vehicles individually, and the money is transferred out of the family every single year. The same thing is happening with your business. That can all be recaptured, and the cash flow can be directed into the family. And this is why we're so passionate about it, because when you bring this together, and like I said at the beginning, the Hispanic culture is so unique because I don't know a group that keeps family closer. Like I said, fiercely loyal. If you can get the family understanding these principles, you have a serious shot at making wealth last longer than 3 generations, which is why we're here. Now, I told you I'd answer all your questions at the end, so we are going to open it up for questions right now, but I'm just going to end with this. This is my email address. Go ahead and take a minute and jot that down, because if you're serious about learning about this, what I'll do is if you send me an email and you say, I want additional info, I'm going to send you some information. I'm going to send you 2 articles that you can read, and it'll answer some of the biggest questions most people have, which is, I've heard whole life insurance is expensive and the fees are very high, which is a complete lie. I'll share an article that exposes that myth. And then 2, the other huge question we get is, why doesn't everyone know about this? And so I'm going to send you another article from a group that is, they have no dog in this fight. They don't get a commission to sell any policies. They are a subscription-based company. So as long as they're producing good content and investigating processes and assets and investments, and they share that information with the public, people keep subscribing to their content. So I'm going to share with you that article. And then I'm going to send you 2 videos. I'm going to send you a video proving to you that that 4% return is the equivalent of earning 8% in the market every year. And then I'm going to show you what this system looks like when you start buying real estate with it. Okay? So I'm going to send you those 4 things, but you have to send me an email. We do not chase clients. We do not hunt people down. We won't put you on a drip campaign. This is about you taking ownership for your family. So you have to take the first step and say, this, I've had it. I want additional info. I'm going to send you those articles and those videos. When you've read those articles and watched those videos, send me another email with your top 3 to 5 questions. I'm going to send you a few more videos answering every one of your questions. And after that, Monty and I would love to sit down with you. We want to take you to lunch. I want to get to know you. We want to get to know your families so we know how to design your system, because everyone is so different. You need a unique strategy. And so with that, I'm going to turn it over to Monty and we'll open it up for some questions.
Well said, Kyle. Also, we have the book in English and in Spanish. We sell them for $20, and we have quite a bit of supply right now. We just got a new shipment in. So contact us if you want that book also. So what questions might you have for us? Because I have some for you.
I have a question. I don't know if this pertains to, you were saying this is really not an investment. It's more of a savings vehicle. So is this FDIC secure? I mean, insured?
No, it's not. Insurance, life insurance falls under a different jurisdiction. And let's just talk about FDIC insured for one thing. If you do your research on it, because if you go into the bank, there's that little placard at the teller that says FDIC insured up to 250,000. If you do your research on it, the FDIC only has about 2%. It's actually less than 2% to cover all deposits. They don't have the money for it. So if you look at the rules of a bank, now correct me if I'm wrong, Kyle, but if there is a big financial crisis, the very first thing they're going to do is shut down the banks. And they're going to limit how much money you can have access to. And then the banks actually have 20 years to pay you back your money for you to get all your deposits back. So that's, people see that FDIC insured and believe it, take it as fact. It's not true. It's not there. It's like Social Security. Yeah.
Interesting.
So insurance carriers have to follow different rules. Because for one thing, Kyle shared with you fractional reserve banking. So every deposit you put in of $1, they can now legally lend out 10. That's just created out of thin air. Therefore, inflation keeps increasing. With banking, it falls under something called Austrian economics. For every dollar they lend out, they have to have at least $1 to back it up. So that's why they're so stable. They can't over leverage themselves like banks do. So in the crisis of '08, who bailed out the banks? Taxpayers. You don't see that happening with life insurance. Great question. Thank you. What other questions? My question to you guys would be, how many of you had to use the PPP program to keep business afloat?
I
know
do.
there's quite a few people. Yeah? Can I move that down?
Yeah.
Yeah. Was that you, Carlos?
Yeah, that's me. Uh-huh.
Yeah. And because we have, not only for Factum, we have stored cash, but also individually, we have stored cash within our policies where we didn't have to, the only paper I had to sign is my signature, verifying that it's me that's taking the loan against my policy. That's it.
So I have a question for you. So obviously with what we had going on with COVID-19, our immediate reaction was really to try to figure out where to reduce expenses. We do have a policy, cash value life insurance policy that had enough cash value where we're now letting that policy pay for itself. So as far as I understand it, that is a loan to ourselves, right? That we're gonna have to repay.
Ideally,
What are your thoughts on that? Because now we are in a position where we could just go back and continue to make the regular payments.
Mhm.
Should we do that, or should we just allow the policy? I think it was at a place where it could pay itself for about 2 years. So I
well,
just wasn't sure on what would be the best strategy to continue to accumulate cash in that bucket.
my question to you, Carlos, is if you borrowed that money from someone else, would you have to pay them back?
Yeah.
And would you have to pay them back with interest?
Yes.
So to be an honest banker, I would highly recommend, if you have the funds to do that, to go ahead and do that. And this is why. Do you think COVID is going to expand? I've heard talks of them shutting everything down again. Well, I need access to money again. And when I have a pool of money that's growing anyway, all I did was refill that bucket so I can pull out even a larger amount next time. So if you have the ability to pay it back, I highly recommend it. But if you don't, a loan against the policy is just considered a prepayment of death benefit. That's all it is. So essentially, you never have to pay that back. We don't recommend that, but you have that flexibility. You have that option.
So meaning that I guess where I'm confused still is like, again, there's cash value. The policy can pay itself for about 2 years. That amount of money that, I guess, is my policy still accumulating cash, even though it's self-sustaining at this point with the cash that I already had?
To some degree, Carlos, because it sounds like the policy you have is kind of like the one Kyle showed with buying the cars.
Yeah.
What happens in that type of policy, if it's with a mutual company, it's going to take a little hit there for a while because they're going to take the dividend and part of the death benefit to pay the premium.
Got it.
So it's going to take a little hit. But after a few years, typically about 10 years into that, it catches and then it starts growing again. But this is my question. Does your money have to reside somewhere? It can reside at the conventional bank where they have use of it, or it can reside in a life insurance policy where I have use of it.
Yeah.
So
And should I catch up with those? I think we're on month 3 of the policy paying itself. Do we need to just catch up with those 3 payments or just go back to monthly payments on the policy?
I'm trying to remember, I know you shared that policy with me before, and who it was with.
Yeah,
We would have
New
to see,
life policy. One,
Good.
well, yeah,
are you on a monthly payment program or is it annual?
yeah, monthly.
Monthly?
Yeah.
I would catch it up. I would call them up and say, hey, I want to catch this policy back up. I want to switch from what you're doing,
Yeah,
where the policy is funding itself, because you can do that. And you want to start funding it again.
okay,
But see, this is what's so great about it. You have the flexibility in down years, while I have no income, depending where you're at with your policy at that time, you can switch it to where it does that, where it self-funds itself, pays for itself.
okay,
That's what's so nice about this, is I have all the flexibility in the world. I have all the options in the world, but the thing is, I'm in complete control. I'm in total control. Without having to pay anyone else interest, without having to pay anyone else penalties, without having to follow their rules, when to pay it. Because if I take a bank loan, I have to pay them every month. There's no negotiating that. But with my policy loan, because I do annual payments, and it's like this for yours too. When I take a policy loan, I get a statement at the end of the year, or when that policy's due, that says, hey, this is how much money you have borrowed out. This is the interest cost. Well, now I have the options. I want to make sure I pay that interest to keep my policy growing. But you know what? I don't have the cash to pay back the policy loan.
yeah,
All right? I don't do it then. But I have those options. But if I have the cash, let me start paying it back.
okay.
All the control in the world. Where every other system out there, you have none.
Got it.
Great question.
Thank you.
I have another question.
Yes,
So, I
ma'am.
mean, typically you think of these kind of, I don't know, policies, whatever, life insurance, whole insurance. For people who are starting off, younger people, what do you think about the older people, say 65 and above, 70 or above? I mean, is it wise to even think of whole life at that time?
It all comes down to that particular incident. The oldest person I've ever written a policy on was 70 years old. One of our great mentors and colleagues didn't learn about this till he was 64, and he amassed a very, very impressive system, owns over 35 policies. So that would be on a one-on-one basis, but this is my thing. I want to be as heavily insured as possible. Most people think contradictory to that because premium, they think of it as a cost. We don't think of it as a cost, we think of it as a deposit. Because in my family, who's most likely to go first because of age? With my wife and kids and grandkids, God willing, it's me. Well, the bigger mass that I can create, I just created a tax-free windfall for my family. Now they're all educated in this process. They're going to take that money, give a call to Kyle, and put all that money back to work in life insurance. This is how the Vanderbilts do it. It was the good stewardship. Now, the other part to that question is, if I can't do it on me, who else can I do it on? And I think we shared last time we talked, that I have them on all my grandchildren. Kyle has a policy on his son. My kids do well enough that they have policies on themselves, and they're still getting more. So I'm gonna take care of me, my wife, and then my grandkids. Because when me and my wife go, the kids are going to inherit this big windfall anyway. Plus, our business assets too. So we've set it up that way that we can keep the wealth going. And this is why we call this a multi-generational legacy. I learned, implemented it. My kids are learning, they're implementing it. Grandkids haven't implemented it. They just need to learn. If we continue that system, we will be more like the Rockefellers than the Vanderbilts. But this is very important for Hispanic communities. Growing up in Hispanic family, they always paid cash, always paid cash. Or they sent it down to Mexico. And Kyle talked about the opportunity cost or the interest cost. When we do that, that money's gone. And I know in Hispanic communities, then when that a person passes, it all comes out of pocket. In my lifetime, with all my tios and tias and everyone else, not one of them had life insurance. Not one. And that was the passing of my parents that made me realize I had to do something else, because God blessed me that I had the money that I was able to pay for it. But I thought, oh my gosh, what am I going to do? Like I said, I was living paycheck to paycheck at that time. What's going to happen to my family? So I made changes.
So I have another question. I
Yes,
don't know
ma'am.
how this makes sense or not, but I'm thinking, so, you know, you have stocks and bonds versus whole life. I mean, what would you do? Would you just invest, or not an investment? Would you just save through whole life and not stocks and bonds, or would you do a combination of both?
Yes, great question, because we get that quite frequently. My deal is, with stocks and bonds, can I lose that money?
Yeah.
Yeah. So what if I put it into life insurance first, right? So I set that foundation. Because if you look at the hierarchy of wealth, the foundation should be life insurance, and that's where banks have their money. The top of the hierarchy of wealth is 401k, stocks and bonds, because it's the most risky. But we're taught as a society is to put our money up here at the peak. So like when Corona hit, some of my clients lost over $100,000 in their 401ks because they don't have a solid enough foundation. Now, I have that foundation. If I want to do stocks and bonds, why don't I borrow against my policy, now put it into the stocks and bonds, and I never lost money because my money's still in the life insurance compounding uninterrupted. Another great question.
Geez, I think we need another class of 101. This is, I mean, it's, if you're not familiar, I mean, it gets really confusing.
Well, because we all have a paradigm. We've been taught certain things and not everything is true. For example, when you were a kid and you went outside with your hair wet, were you told you were going to catch a cold?
Yeah.
That's not true. But it was set in our paradigm. So, oh, I got to, you know, I grew up in northern Arizona where it gets a little cold, you know, and so, oh, we're going to catch a cold. We go outside with our hair wet. And it's not true. We took it on as a belief, and it was having to learn some truth. And that's all we're doing is the truth about money. This is what the people that created the the Federal Reserves, central banks, they do this. That's why it's so powerful. The elite do this. And this needs to be shared tremendously with the Hispanic community.
I agree.
You know,
Totally agree
even
with that.
if it was only at a family level, if they had enough cash value, let's say that for the rent, they can borrow, pay the rent in full. And this is what most people don't know. If you offer to pay your rent in full for the year, do you think it's likely that they'll give you a discount? We have clients and colleagues that have done that. got 1 month free for doing that. So they essentially saved $1,500, but they just paid back to their system all year. So what if I did that with my business? Buy something for my business, a vehicle for my business. There's so much money that we're leaving on the table. If you use your vehicle for business, are you leasing it to your business so you can have another tax deduction? That's another thing. If I borrow it personally and lend it to my business, wow, I just created a tax deduction for my business. I gave capital to my business so I can grow, because that's what we need to grow a business, right? Capital. Now I had this influx of capital. I created a tax deduction, but the whole time my money was over here in my life insurance policy, compounding. So I'm making money while I'm saving money. What am I going to do with it? Run it back through my policy. We would love to sit and spend time with you, and you know, like Kyle said at the beginning, this is for the most people, it's 10 hours of exposure to this, because all those wheels are start turning, that you're starting to say, you're having that conflict of what you've been taught and the new truth. Jesus said, I'm the truth, the light, I'm the way to the Father. This is the same with money. Any other questions?
No more questions, anyone?
Well, what
No.
else can we do to help you?
Well, I want some more class.
Well, this is what we do say. It's an old Chinese proverb. The best time to plant a tree was 20 years ago, right? Because we're enjoying the shade from a tree that somebody planted a long time ago. The next best time is today. So each day that we wait to start a system, this process, we lose money. And what I mean by that is I'm 53, Kyle's 31. If we were to do the same policy, the same amount of dollars, because hopefully God blesses me to live a long life, but Kyle has that 22 years of difference of compounding. So the day I'm called, if we were to die the same age, he would amass more money than I would, because of those years of compounding. So we don't lose money the first day, we lose it the last.
Wow. Well, that was, I'm telling you, to me, these are like one of the most interesting presentations that I've heard. And I'm very thankful that we're, you know, as part of our chamber, you're able to do these presentations for our members. I think they're very important. And like you said, you know, also for our Hispanic community, because I don't think a lot of them even know about these kind of savings and how beneficial it would be for them. I know we all tend, I know my grandmother would hide her money in the coffee can and, you know, stash it somewhere, but I don't think that's the best way to do things anymore. But I know, Carlos, are you still on?
Yeah, I'm still here, Frankie.
Okay, yeah, so before we close, I just wanted to, I know we went around and introduced ourselves. Carlos, also one of our board members, and he's done very much for the chamber. I'm very thankful to him for all his knowledge and all of what he does for our chamber. So why don't you introduce yourself, Carlos?
Oh, thank you, Frankie Joe. It's a real honor for me to be part of the East Valley Hispanic Chamber as a board member. My company is Noble, and we focused on connecting companies to communities in a way that is meaningful and also profitable. And Monty, again, thank you for becoming a member and for facilitating this this presentation today. And I know that this is continual education, so I'm sure that there'll be more opportunities to bring you. Well, hopefully once we get out of the pandemic, right, we can do some of this stuff grassroots, because we as a chamber do believe in financial education as an important resource to our small business community. So again, thank you and Kyle for taking the time and providing this type of education to us.
Well, thank you. Appreciate that.
Yeah, I second that. So just a reminder again, that our next webinar is going to be on the 23rd, how to start an e-commerce. Also on the 24th, we have our Hablamos de Negocios, which will be done by National Bank of Arizona, Manny Lucero, and Mesa Rail. So I hope you'll all be able to join us. So with that said, thank you everyone for joining us today. I appreciate it. Please continue to be safe and healthy. And I hope we'll be able to get together soon. So if anybody has any topics that they think might interest our members, please reach out again to Rebecca or myself and let us know. So again, thank you, Kyle and Matt. Appreciate all the information and we look forward to having you again.
One last thing, if you don't mind.
Yeah.
When we do live events, we would love to invite you. And if you feel comfortable with the mask and so forth, we'll love to have you, because that's truly when you can interact with other people that are doing it and so forth. My mentor once said, learning but not pulling the trigger is like learning how to swim with just sticking your toe in the water. You learn so much more once you get into it. And that's where the true growth is. So if we can add any value to you guys, please let us know.
Right.
All right.
Thank you so much, everyone. Please take care.
All right. You too.
Thank you.
Bye-bye.
Bye-bye. Oops, and first.